Hello friends, in this video today I am going to talk to you all about the ETF, exchange traded funds. Now how many types of ETFs are there? There is a equity exchange traded funds, there is a global equity exchange traded funds, there is a gold exchange traded funds, and there is debt exchange traded funds. I mean, these are the four major broad categories of ETFs. Now what is ETF? Basically ETF is in one script, a bundle of several scripts which derive the underlying value of those scripts into this script. You got me? It's a composition of, like in case of equity ETF, it's a composition of say Nifty ETF, so 50 shares index, Sensex ETF, so 30 shares index in one. Now you will ask the question that why ETF? It's already available in future market or in mutual fund. There are various funds and schemes which also have similar composition. So your question is correct. But I will answer you why the difference and why one must use the ETF or go for ETF. The major difference is that ETF is a cash market instrument, cash segment. So suppose if you buy 100 shares of Reliance in cash segment, today in the Indian context, our markets, you have to take the physical delivery if you have not squared up at the end of the day on T+2 basis of 100 Reliance shares. Pay the money, shares will come in your account. Similarly, in case of ETF, any XYZ ETF, you are buying in the day, during the day, you are trading, but at the end of the day, whatever is the balance left is you are taking a delivery. It means on T+2 basis you have to make the payment, I mean whatever the cycle, and it will come in your account physically, I mean in demat form. Whereas in case of futures, nothing comes in your account. Only the entry takes place, buying, selling, and you are marked to market and margins. And at the end of the settlement of that contract, which is monthly, 1 month, 3 month, whatever is the contract, 1 month, 2 month, 3 month, you will get the cash in settlement, nothing in physical in your account. So this is the major difference. Same way, in case of the mutual fund, you buy the fund unit in the fund, the ETF, I mean just like ETF. But that every day at the end of the day NAV you get on the next day, the closing of the last day, and at which you subscribe to the mutual fund. But here, at any point of time when the market is on, from 9:30 to 3:30, I think 9:15 to 3:30 in India today, you can buy sell at the real price in the market. You don't have to wait for NAV. You can enter, exit any time. And another beauty is that when the ETF is in your account, it's just like any other stock which is there in your demat account. And you can sell any time. At 1 o'clock in the afternoon you sell at the price which is there in the exchange, sold. And you get the money on the settlement day. So none of those hassles, those loading of charges by the mutual fund. Of course, on ETF, you have to pay the brokerage, the commission to the broker, just like on shares. Maybe the rate differs little bit here and there. So in case of the equity ETF, it is a composition of various equity stocks into that one ETF. In case of the global, yes, we do have, I think we have Motilal Oswal Global Fund, we have Goldman Sachs Global Fund, where the international stocks are converted into ETF and traded here. So in fact, you can draw that pleasure of having that stock in your account. About gold, I think everybody is familiar. That why, I mean, unless you need the gold for making the ornament to be gifted or to be presented or to be actually used on day-to-day basis. Other than that, if you are just physically buying gold for taking a pleasure of having a gold, maybe planning your daughter's wedding after 15 years or 20 years, so it is better to buy ETF and keep it. No hassles of physical gold, no tax, and it comes straight in your account as an ETF. The other advantage is that it is converted into a very good market price units. Like when you go to buy a physical gold, if you buy 1 gram of gold, it will be very, very small particle or a piece of gold. You would not like to buy less than 10 grams or say at least 5 grams. But here, you just buy the ETF of that range and that much gold comes to your account. And you have 10 such ETF, it becomes multiple by 10, that much quantity of that unit. So units are affordable. You know, it can be bought and sold in a even smaller quantities and values. And all well governed by the exchange. Clearing corporations, guaranteed mechanism of your money and your goods in ETF. Whenever you will sell, you will get the price. Whenever you buy, you give the price, you will get the stock in your account. So my dear friends, ETF is a very good way of investing into these asset classes, which are good assets. You can decide your proportion in various class of assets very easily and make the investment. Like I was talking about the debt ETF. Debt means securities which are debt securities. You know, 5%, 7%, 8% return securities, debt, and that gets combined into one unit as a ETF, and you have a composition of debt. Similarly, in case of a equity, you have a diversified portfolio into one ETF. So no risk of one stock going up or down. It balances. So I think ETF in India today, especially for the large number of smaller investors, is a very good tool to take the positions in the market, whether equity market, overseas equity market, whether the gold market or the debt market. I think I am clear to you. Thank you.